Okay, we're talking about our methodology today. This is somewhat detailed and very theoretical. If you really want to understand the underpinnings of what we're doing, this is the one. This is the presentation that built the company, really. It's 4 simple slides, although I can go into some detail on each one of them. And it really is the technical presentation. So if you really want to know what we're doing behind the scenes and you want the theory, this is the one. And like I said, this is the presentation that built the company. This is what I bring up in front of portfolio managers. 4 slides, drill down pretty hard on the calculations, and and then I bring up the software, and we'll do that. And I don't know how long this video is going to take. I hope I can do it in 10, maybe 15 minutes. But I will do my best to stay on track. And I've done this one so many times. I could do this in my sleep. I ought to be able to do this in one take, unless I have some technical difficulties. Other than that, I know this thing by the back of my hand. In fact, I would say I can almost see myself while I'm doing the presentation. Like, I just do it so subconsciously that I can at the same time observe myself. And once in a while I say something that I've never said before, and I say, wow, that was really good, or oh, you're off today, your flow was not very good. Anyways, that's enough about that. Let's just do it. Jump into the slides. Okay, so I'm not counting this as one of the slides. It's just the header or the title page. 4 slides. Okay, so we're all about return on invested capital and cash flow and valuation. If you remember nothing else about FSA, it's about cash flow, return on capital, valuation. Okay, I'm going to talk about return on invested capital first. And we use this cash flow IRR, which we think is just a superior way to calculate return on invested capital, rather than you can use an ROE, an ROA, ROIC, something like that. And we make adjustments to the accounting statements and adjustments to those measures because we think it better reflects the true economics of the business. And that's really what you want at the end of the day, is the true economics of the business, right? Okay, so first things first, we need to talk about the down arrow there that you see there. That is the invested capital. It is a standard definition of invested capital that you'd get right out of a CFA textbook or any finance textbook, with 2 adjustments. Okay, there's 2 major adjustments. The first adjustment is we add back accumulated depreciation. Okay, and this comes as a surprise to many people because they're thinking of valuation. When you value a company, it's true. If it's depreciated, it's like it's sunk cost. It doesn't matter anymore, and that's absolutely true. But we're not talking about valuation here. We're talking about judging management's ability to get a return on invested capital. And you want the original amount of money that was put into the business. Okay, it's just like any investment you've ever made. If you buy a stock, if you buy a house, if you buy a business, a car to rent it out or something, anything, any business, any transaction you buy, you would never, judge yourself on it whether it was a good investment or not unless you looked at the original amount of money, right? Let's say you bought a rental property, okay, and it cost $500,000, and you renovated it and then rented it out. And then maybe 10 years down the road, they usually appreciate, but there's some depreciation in some things you got to fix and all that stuff. But let's just say the market was flat and the depreciation's there from wear and tear. You would still say, well, I spent $500,000, then I spent some more, with the depreciation and upgrading and all that kind of stuff. So that would be the original amount of money, not the depreciated amount, which it would make sense for valuation, but not for judging return on invested capital. Okay, it's a big deal to understand that. Okay, the next thing we have to do is inflation adjust that down arrow as well, because that is the investment, but it's recorded in historical dollars. Okay, right? So if you're an older company, for instance, You may have assets that are 10 and 15 years old or even older, and yet the cash flow and income is in today's dollars, but that investment is recorded on the balance sheet at the time of whatever you purchased it at. So again, we're just, our purchasing power is being eroded, and we're not adjusting the balance sheet at all to reflect current conditions. So we inflation adjust that. Okay. So again, two major adjustments: we add back accumulated depreciation, and we inflation adjust the balance sheet. All right. So now let's assume we've got a good capital number. Well, now we want to compare it to what we're earning, and we're going to use cash flow from operations. Now, cash flow from operations, you can come out at this from the top down or the bottom up. Let's do the definition we got on the screen here. I find this one probably just as good as any. You start with the net income, but in net income there's a few items that we would adjust. So we would say add back depreciation and amortization because they're non-cash items. Okay, it's cash on cash. Again, cash is king, not earnings number, which is calculated for how much you're going to pay taxes on. But as a shareholder, you really care about the cash flow. Okay, so you got to add back the non-cash items. You also add back interest expense. Okay, because we want to be able to compare it. If a levered firm and an unlevered firm, it really doesn't matter how you financed it. You still got to get a return. So if it's a equity finance, there's no interest charge, but everyone's diluted. And if we have a leverage finance or debt finance, then there's an interest charge. Well, I don't really particularly care to judge performance where I got the money from, right? So I'm going to add back the interest expense, and you do an after tax because there's a tax shield, and we want to make sure again that it's just apples to apples. Whether I debt finance or whether I equity finance, we have to make sure that it's on the same basis. So that's why we have to adjust. Okay, the other adjustments, we add back, one-time special items. That's a very common adjustment. If it's, I don't know, let's say we're restructuring and they get consultants in for a couple of quarters and that costs some money. Well, that's not an operating expense. It's a one-time expense, or maybe some legal expenses, or there's a lot of things that can go into one-time things, and you don't want to include that. And that's when you'll often hear too when you read press releases on earnings, and it's always adjusted, and it's really pain in the neck because you hear the earnings on a GAAP basis, and then they say an adjusted, and you're like, well, what are they adjusting? Wait a second, you can't just adjust it just to suit yourself. They're not doing that. They're just taking all the one-time items. Okay. And we would do the same thing, and every good analyst would do that. I think that's pretty standard, and most analysts would actually use a cash flow from operations, depending on the business. Almost every business, though, cash flow from operations is a better number for valuation and judging, management's ability to earn a return than income. Okay, income is for calculating taxes, and in fact, you have an incentive to lower that as low as possible, right? So you might make a depreciation policy decision. You may decide to take an aggressive depreciation because you get a better tax write-off. It hurts your earnings, doesn't even affect your cash flow. I could do a whole subject or topic on that one. It comes back around because then you're not writing things off, or you're writing things off too quickly, but then they stay on the books, and okay, we don't need to go there. That's getting too technical. Okay, so now we have the up arrow and the down arrow, and then we have to look. We're not even done yet. We have two more steps. We could take a ratio. Actually, a ratio is pretty good. The up arrow over the down arrow. It's not bad. It's not bad. At least you've got cash on cash returns. The only issue, though, is companies are very different, right? It depends on your asset life. Like a software company is a very short asset life. So you better make some cash flow quicker than if it's, say, a steel company that lasts a very long time. So you can have a lower cash flow relative to the capital base in a steel company, because I mean that steel factory is going to last 30 years, whereas software actually has a very short asset life. At least all the features need to be upgraded, and sometimes yes, the core, let's say its calculations can stay the same, but you're always upgrading to a new version, you're always building on it, adding features, all these things. So they actually depreciate software pretty quickly in economics. Okay, so that's why it's kind of that lighter color going forward. It's not a prediction of cash flow. It's just saying, well, based on what we currently know, we're earning this much cash flow from ops and an asset life that we can just get by using a gross plant divided by depreciation expense, and we have a good idea of the asset life. And I've been in many meetings with CFOs and CEOs, and I'm just using their publicly available information, and I would say, so your asset life's probably about 10 years or whatever it is, and they're like, yeah, that's pretty close. Yeah, how did you know? Like, I said, well, we just reverse engineered your financial statements. I know your depreciation expense, I know your gross investment, and I just I just reversed it. It wasn't that hard. Okay, so now we have to talk about salvage value. Now, again, we're talking about return on invested capital right now, not even valuation. But it is important to include the salvage value in just your estimate of what the company's actually generating in a return. So, for instance, a company like Apple would have a lot of working capital. We call it salvage value. Sorry, I kind of skipped over that. Salvage value, we say, is the working capital, right? Like if you ran this, say, factory or whatever it is into the ground, without replenishing and replacing, then what you would have left over would be the salvage value. So, and that's included in that first down arrow as well, right? Like that's capital you need to get a return on. So a company like Apple's got so much cash, it goes into their invested capital, but it's not really deployed, and it drags down their rate of return on capital. So to mitigate that, we'll call that salvage value, and improves a company's like Apple's return on invested capital. Another good example would be, say, a smaller company that is growing and they're raising capital, right at the end of the quarter. So what happens in accounting is you could literally double the size of your balance sheet in a financing, right? You go from 100 million to 200 million in one financing, and yet on the books it says 200 million in invested capital, and yet you haven't even earned anything from it. It literally just came in the door. So if we don't put that into salvage value or mitigate that distortion, then the company that's growing really fast is just going to look it's just not going to look good enough. It's going to be like, oh, this is a terrible business. But when you make this adjustment, then you realize, oh, okay, we're adjusting for net working capital, and give it a chance to be deployed. Okay, so that's, I told you this is pretty technical. Now, that's probably the most technical slide, the very first one. Although there's a few more. It's still coming. Okay, so as I said, I have not changed this presentation for 20 years. This is a steel company versus a software company, and these actual numbers are from Dofasco in Canada and Cognos also in Canada, and both these companies are gone. They've been taken out. But I just these are really good numbers. It really just demonstrating that a steel company has just a very different profile. It has a long asset life. It's got a lower cash flow from operations, but it's got the long asset life, so perhaps that's okay. It doesn't have much cash on their balance sheet typically, and whereas Cognos is more like an Apple. It's got a big salvage value or working capital on their balance sheet. So you see that big arrow on the right as salvage value. It's got pretty good cash flow, but you got the short asset life. So if you don't walk through the math and you're just doing ratios and you're just using standard accounting ratios, you're not going to get the true return on capital number. And that's really all you want is the truth, right? And that's what we're trying to do there. Okay, next slide. Okay, valuation. This is pretty technical too, but you'll get through it. Okay, we do what's called a value-added valuation. Okay, so what does that mean? Well, we take the salvage value, excuse me, I don't know what I'm talking about here. We take fixed capital plus working capital. And this time we're going to use net working capital. Okay? Because it does matter for valuation if you have old assets. It does make a difference. You need to account for that. And then you add in the working capital, and we say that's kind of our starting point for a value. Certainly if the accountants are telling us it's worth, the fixed capital is worth this, the working capital is worth this, I mean, that's a start for valuation. Now, typically stocks trade much higher than that, and it's because of the speculation on how much money they're going to earn going forward. And only the part that counts is the part above the cost of capital. So if you earn greater than your cost of capital, then you're going to add value. You can detract from value or destroy value. That's the word I'm looking for. If you earn less than your cost of capital, you can actually, the fixed capital and working capital can be worth less if you're generating returns that are lower than the cost of capital. So we show the positive case. I don't need to show the negative case. And then we say that's the total value of the company. Then we take out the debt, also off the balance sheet, and whatever's left over is the value of the equity. So, you know what? I see this has already been 16, almost 17 minutes. I'm gonna have to do this in 2 parts. So we'll come back to this slide in part 2.